Welcome to Market Catalysts. I'm Julie Hyman, and we are 30 minutes into the U.S. trading day. Here's what we are watching to start the hour. First up, we're going to preview what to expect from Nvidia amid the sell-off in big tech. Plus, we're going to hone in on crypto amid Bitcoin's plunge and what it means for the digital asset sector writ large. And we break down the winners and losers of the retail sector and what that spells out on the state of the consumer. Let's get a check of the markets here because we are seeing a little bit of a bounce back after the recent bout of selling that's been going on. Right now, the Dow's up about 93 points or so, about a fifth of 1%. The S&P 500 up 0.8. The Nasdaq is leading, just as it led to the downside, and we've seen this tech sell-off over the past few sessions. Now we are seeing a bounce of about 1.3% in the Nasdaq. And I said, it was the past few sessions. Really, it's been more than that, right? If you look at the 1 month chart of the NASDAQ, you can see a little more clearly here the sell-off that we have had for that index. And this on concerns about overvaluation, about overspending on AI within that market. So we'll get, of course, Nvidia earnings after the close today, and we'll see if some of these concerns are allayed. That remains to be seen. But ahead of that, Nvidia shares are picking up a little bit, right? They're up by 3.2% today. Again, if you look at a 10-day chart of the stock, you see that it has been selling off into the print. So does that mean there's more chance for upside here? We're just going to have to wait and find out until the numbers come out. Alphabet also bouncing this morning about 6%. Broadcom up about 5%. Also, I'm noticing on the market cap weightings here, because this is what the sizes of the boxes here are dependent on market cap, that Broadcom is now bigger than Meta, because Meta has been falling as of late. So that's an interesting development as well. But generally seeing a bounce here. If you look at the sectors on the move in the S&P 500 today, not surprisingly, the one that's really leading gains is XLK, which is the tech sector. Communication services also doing pretty well. And then you've got energy and consumer staples, which had been the ballast, had been doing better during the recent sell-off. Now we are seeing those groups decline. Also want to check on what's going on in cryptocurrencies, because here too, of course, we have seen a sell-off going on as of late. It continues in some places. Ripple's down, Solana's down, some of the other various coins are down. Bitcoin itself, there's the 10-day chart, not a very pretty one. It's up just about a third today, but still below 92,000 per token. And if you kind of stretch it out, let's stretch it out to a year to date here. Of course, we had that big run and went up to a record high before the declines that we have been seeing more recently. Let's dig into that now, because that drawdown from the record high for Bitcoin in October is about 30% here. And this is then causing Bitcoin ETFs to see record outflows. Investors pulled more than $3 billion out of U.S. Bitcoin ETFs so far in November. And that's just the spot ETFs, by the way. Joining me now is Ryan Rasmussen, Bitwise head of research. And Bitwise's Bitcoin ETF, one of the largest in the U.S. So they have a sort of front row seat to a lot of this stuff. Ryan, it's good to see you. So where's the bottom in this recent drop here? How do we figure out when we're maybe getting close to that level?
Yeah, it's great to see you as well, Julie. I do think that we're closer to the bottom here today than we have been for the past few weeks. We've certainly seen a large amount of outflows out of Bitcoin ETFs, as you mentioned. And I think Bitcoin really was a leader of this risk-off move starting in mid-October, and I think we'll be a leader to the upside once things start to turn around. And I think we're closer to there today than we have been a week or 2 weeks ago.
I was reading a really interesting analysis yesterday about what was going on with this Bitcoin drawdown. And, the invention or the introduction of the spot Bitcoin ETFs was seen as a great step forward for the industry and a step towards institutionalization. And we've had more steps this year, right, because of policy support, et cetera. But it can be a double-edged sword, because with more liquidity in the market, that means things can maybe go down a little bit more fast, right? So how should people be thinking about that?
Yeah, I think that's exactly right. Bitcoin, in our view, is one of the biggest technological developments of the past 15 years. And I do think that as the market matures, that brings in new investors and adds more liquidity to the market. But what that also means is that we're seeing a lot more choppiness in times where risk-off moves happen or investors are unsure. You also have participants like hedge funds that come in and out of the market depending on what the basis trade is allowing them to do and where they're seeing activity happen. And so you just have more market participants. I do think over the long term that reduces volatility as we make this move from a early stage retail-driven asset to an institutional asset. But I do think throughout that journey, we're going to see some choppiness, and certainly over the past month, we've seen that.
I mean, it hasn't seemed to reduce volatility thus far, right? I mean, we're still seeing quite a lot of volatility here, and it doesn't feel like that, there are not the sort of buyers in size coming in as Bitcoin has been falling.
Yeah, so if you look at the trend over the past 10 years, volatility has certainly been falling. But over this short-term period, you do see spikes in volatility. That's certainly correct. The buyers for Bitcoin that we're seeing come into the market today are more long-term buyers than we've seen in the past. The wealth managers and the financial advisors that we speak to at Bitwise are adding Bitcoin to model portfolios. They're rebalancing on a standard basis. That should all reduce volatility and add more long-term demand. But there's some other elements at play here, like the corporate treasuries that are purchasing Bitcoin were coming in size earlier this year, and that's really dried up. And I think that demand side of the equation drying up is what's in part due to this sell-off that we've seen in October.
Okay, so what will change that? The best cure for that is low prices, I assume, or lower prices?
Yeah, lower prices are a gift and a curse, of course. A lot of investors are feeling pain right now who bought Bitcoin above 100 or closer to that 125,000 mark. But we believe that Bitcoin's going to end the year higher than it is today. As I mentioned before, I think we're closer to the bottom short term than we were a couple of weeks ago. And I do think in 2026, Bitcoin's going to go much higher. Institutions are finally here. That doesn't mean that right away they deploy all of their capital. It doesn't mean that everyone onboards right away. But even Harvard, we saw with their recent filing, is buying Bitcoin in their endowment. So I do think institutions are finally here. And I think that's a long-term tailwind. And as they buy more and more Bitcoin and other crypto assets in 2026, in 2027, I think that demand long-term drives the asset higher, reduces volatility, and allows Bitcoin to be incorporated into more people's portfolios.
One of the interesting things I've seen as one of the reasons perhaps behind the recent sell-off is the changing perceptions of whether the Fed might cut rates in December. And I think it's so interesting when we talk about Bitcoin that's supposed to be this asset that's kind of divorced from everything, reliant on a Fed rate cut? I mean, come on. It's a little bit, we're supposed to be freed from the shackles of fiat currency or whatever. That doesn't feel very freed from the shackles.
No, that's exactly right. That's a criticism that a lot of investors we speak to make and have observed. And I think post-COVID, we've really been in this fiscally dominated environment where rate cuts and other macro elements do play more of a role. We've seen correlations of Bitcoin to equities spike or raise in that environment. It's closer today to that low correlation range. And pre-COVID and this fiscal dominance, it was just an uncorrelated asset. So I do think it is a bit ironic that this untethered sovereign store of value now has a little bit more driver related to macro markets. And it's really an asset that's performed remarkably well in low rate environments and risk on environments. And of course, right now there is fear around whether the Fed is going to cut rates at the December meeting and how many cuts will happen in 2026.
So if they don't cut in December, what happens to Bitcoin?
I think that right now, no cut in December is largely priced into the market. I think Bitcoin's really been a leading indicator of where markets are headed, and the fact that it's bottomed out around 90K and you're starting to see a recovery in some other asset classes as well, including Bitcoin. I think that the lack of an interest rate cut in December is likely priced in and that people have already started to turn to 2026.
Do you guys have a price target for next year?
So this year we had a price target of 200,000, and I think it's safe to say that come December that's not going to happen. But we do believe that in 2026 Bitcoin will hit 200,000, and it's because those institutional investors are coming in waves, whether it's wealth managers or endowments or pensions or corporations or governments. We think all of that capital coming into the space is just creating a systemic imbalance of demand versus supply. So we believe Bitcoin will hit 200,000 in 2026.
Okay, we'll check back.
Thank you. Looking forward to it. All right.
Thanks a lot. Appreciate it. Coming up, what the recent sell-off means for semiconductor stocks, plus why memory chip prices are on the rise and the effect that's having. the major tech companies going all in on AI, spending hundreds of billion dollars in capital expenditures to build out their capacity, there is one aspect that could get even more expensive: memory chips. And not just the high-powered ones typically used in data centers, but the ones that are part of consumer electronics like smartphones and computers. Here to explain, Yahoo Finance tech editor Dan Howley. So what's going on here?
Yeah, so data centers use this thing. It's going to get real nerdy. Hold on. I promise it'll get better. They use this thing called DRAM, right? And then they use that to make what we call HBM, high bandwidth memory. That's the stuff that's basically the memory inside of these data centers that they use to run AI. Problem is, DRAM is a common thing that is also used in smartphones, in laptops, in medical equipment, in cars. It's not the same. It's not HBM. It's called DDR. So they basically are just two different offshoots of the same thing. Now, memory makers get higher margins selling HBM versus DDR, which is what you would use in your laptop. And so we're seeing an increase in price for RAM for things like your laptop, smartphone, medical equipment.
So basically what they're doing is they're probably diverting some of their capacity that would normally be used for DDR, the stuff that goes into more everyday electronics, to make HBM because they're earning more money on it.
Yep, exactly. And so because of that, we're starting to see prices, go from, they sell DDR in sticks, right? And so we're seeing prices go from about $100 to $250 in a matter of weeks. And so it's going to continue on this kind of spike. And the thing about the memory market is it's incredibly cyclical. And so you'll have these kind of dearths of memory for consumer products or other types of products, and then you'll have a glut and prices come back down. And so right now, it's kind of in a weird space just because when was the last time we had this massive, build out of data centers? Never, right? We had, the cloud, as that was taking off, data centers are being built, but there seems to be a lot more of a rush to get these AI data centers built. And so because of that, the RAM is just disappearing faster and faster.
Well, and there just aren't that many companies that make it either.
No.
What, are there 3 companies?
There's 3, and then there's other memory companies, but the big ones are SK Hynix, Micron, and Samsung. And so, they're doing both of these now. And so there's a few things that companies can do to try to get the prices back down. They can lean on those suppliers. I mean, good luck on that. They can make devices that are less powerful, or they can raise the prices. The problem is, we're coming up to the holiday season. People are going to be going out and shopping. If they're going for lower end products, there's not a lot of margin room.
But is this something that will affect the cycle that quickly? In other words, when will it start to make its way into actual device prices?
I don't think it's going to hit necessarily that soon, but it will start to hit, I would say, maybe in the next few weeks, next month or two.
Gotcha.
It really is going to be something that will start to see creep up. And again, it depends on how these companies are going to handle this, right? Are they going to pass on the pricing? One expert that I spoke to said, yeah, it's on us now, right? Others have said, maybe they won't, maybe they'll find other ways to change the pricing structure of their devices, whether that's consumer or whether that's going into commercial. So it is going to be one of these things that, a kind of unforeseen issue of this data center build out, right? It was, electricity, water, GPUs, okay? Now it's like, oh, well, now my laptop's more expensive. Why is that a thing? So yeah, it's going to be an issue for a while.
All right, we'll keep an eye on it. Thanks so much, Dan.
For sure.
Appreciate it. Let's talk more about semiconductors right now, because broadly we've seen tech stocks under pressure in the past week. The S&P 500's tech sector down nearly 4% in the past 5 days of trading. Specifically, the Philadelphia Semiconductor Index down about 5% in the same period. And of course, we're all watching Nvidia ahead of its closely watched earnings report after the close. So what does the tech sell-off mean for chip makers more broadly as well? Let's bring in Jim Schneider, Goldman Sachs senior equity analyst. I want to ask you about the memory issue too, but we'll get to that in a moment, because first, this sell-off that we have seen, which of course has rolled up the semiconductor players as well. How are you thinking about it, and thinking about the sort of the market perception of spending on AI and the reality that's priced into these stocks?
Very good. Good morning, and thanks for having me, Julie. Appreciate it. I think what we've seen is the semiconductor stocks, as you said, have pulled back from the highs. Nvidia probably 8 or 9% off the highs today. I think what it really reflects is, first of all, a bit of a consolidation off of a lot of market announcements we've seen in the market, both by the hyperscalers, the cloud providers, as well as companies like OpenAI, in terms of new infrastructure announcements, really a flurry of those announcements over the last 2 to 3 to 4 months. And so I think some of those headlines are being digested right now. I think it's normal to see after a run-up in that nature, some level of consolidation. It's kind of normal to see even some profit taking. I think there's another element too, which we've seen some concern around whether there's actually enough power and enough financing for all these data centers to actually be built over the next several years. At least over the next 12 months or so, we're actually fairly constructive that's going to happen and play out. But the power and financing are two things that we're watching very closely.
I was really struck yesterday by the Bank of America Fund Manager Survey, which they do monthly, and they found that participants, I think it was something like 20%, said that there was an overinvestment in this cycle, or that companies were spending too much on the data center play. So do you think that there will be overspending and then there will be a rationalization of it at some point?
We don't see that today. In fact, we see headroom for significantly greater spending. And what really enables that is some of the most profitable companies in the market, the hyperscalers, the cloud providers, they are seeing the benefits of AI monetization. They're actually seeing acceleration in their revenues. That enables them to spend more and to continue to grow their CapEx spending. And in fact, we've seen pretty significant revisions for, at least our analysts are now projecting a 36% increase in hyperscaler CapEx among the top 5. And if you look at street estimates, that's over 15% upward revision just over the last 3 months.
Wow. Okay. So what does all of this mean for Nvidia, which reports after the close today? I mean, the numbers there also just keep getting revised upward.
Yes, and we're expecting the same thing tonight. So we're expecting the company to deliver a very strong quarter above the street. We expect management to guide above the street for the January quarter as well. And really that's going to translate to nearly 60% year-over-year revenue growth. So that's still very, very healthy level of growth. And really what's driving that is the data center segment for Nvidia. That's both the processors, the GPUs that they're providing to actually process all the AI queries, both on the training and inference side, as well as the networking chips that sort of stitch all those processors together and allow them to talk to each other.
Jim, what is the biggest risk for Nvidia? If there are any cracks, where would you be looking for them?
Yeah, I don't think we're going to see many cracks this quarter. I think that people continue to look for elements of increased competition in the space. It seems like Nvidia still has a very, very strong hold competitively, especially on the AI training workloads. And those models, those LLM models, are still evolving very, very quickly. And so the programmability that Nvidia affords you and those developers is still really kind of commanding a premium in the market. So we don't really see that slowing down anytime soon.
Do you have any concerns about sort of OpenAI at the center of a lot of, or the whole circularity that's been talked about a lot of the spending cycle, where the company at the middle of it all doesn't make money, isn't expected to make money for a long time, and its revenue is far outpaced by the spending that we're seeing?
Yeah, I think it's not the circularity per se. We've written something about this, almost a month ago now, relative to Nvidia, and so I think it's really the question about the financing needs of OpenAI and other companies which don't have very strong free cash flow. Their spending is going to be contingent upon their ability to get financing in the market, both in the debt and equity markets, and so that's really, again, one of the things that I'm watching for very closely. But I think 85% plus of Nvidia's revenue is still driven by those hyperscalers. That's driven very, very strong growth, and they have the capacity to spend more.
Nvidia shares, of course, are popping today, but they've been falling recently with the rest of the tech space. Does that mean that, and Nvidia in recent quarters sometimes falls, even when they beat, even when they come out with a big forecast, but the fact that they've been declining, does that maybe ratchet up the chances that we could see a positive reaction to the numbers?
I think it increases those chances. And in fact, all the positive data points that we talked about, as well as their developer conference a few weeks ago, really kind of suggest a very positive setup for numbers. If we were talking about the stock price let's say 10 days ago, it might be different, but I think with the pullback in the stock, that kind of really makes it a little bit more attractive risk reward ahead of the quarter.
Yeah, I was actually reading your preview note, and you said something like that the shares have been strong into the print, and then I looked at the date, and it was late October, so then I realized what was going on. I do want to ask you about the memory chip story that we just heard about from our Dan Howley, the idea that because the memory chip makers are making a lot of high bandwidth memory chips, they're not maybe making as much capacity in other types of memory chips and driving up prices. How long does that continue?
Probably a little while longer. And I think what we're seeing both on the DRAM side and the NAND side is that suppliers are not really adding much new capacity. Now the CapEx, meaning the capital spending for those new factories, is starting to come online. There is some supply being added, but there's still supply being taken away from those legacy DDR chips. And so we're seeing prices go up pretty substantially, certainly for the DDRs, but even for the HBM chips that are used in AI servers. And so, really don't see any kind of stopping of those pricing dynamics, at least in the next sort of 3 to 6 months.
And we were just sort of debating what then the customers are going to do. I know you focus more on the semiconductor makers themselves, but do you have a view on whether, Micron and SK Hynix, et cetera, whether their customers are going to pass on those increased costs, whether they'll eat those increased costs, whether they can try to negotiate? What do you think happens?
Well, I think in the very short term, at least, those customers have some buffer because they have contracted pricing in advance. Maybe it's 3, 6, even 12 months in advance, but at some point, there will be a reset in those contract prices. And so there is some risk there that if those costs go up, and I don't have a view on what will happen to the pricing for the end consumer devices, but there is a risk that there's upward pressure on those costs for sure.
Jim, thanks so much for coming in. Appreciate it.
Thank you.
Thanks. Well, the AI trade and the future of the technology was in focus at our annual Invest event last week. Our Yahoo Finance executive editor, Brian Sozzi, spoke with Reddit co-founder Alex Ohanian about everything from valuations to the risks to the labor market, and here's a part of that conversation.
You're a father of young children. What is this AI revolution? What will it mean to how they learn? But in addition, what does it mean for that generation, their ability to find jobs 15, 20 years from now?
Well, okay. So on the latter point, I don't know. I want to believe I'm a tech optimist, and I do think more new jobs will be created than removed from the system. I think an easy example, we were fortunate to be early investors in a guy, Mr. Beast, 5 years ago. The idea of being a content creator, let alone a billionaire because of it, was unthinkable, 15 years ago, 20 years ago? And now it's probably one of the most common professions that a young kid, at least in America, wants to be when they grow up. So there is precedent, right, for, social media, that revolution was a significant one, not nowhere near as big as AI, but it was one that created entirely new career paths, sectors, industries that didn't exist before. And with every technological revolution, there's always new careers, new things that come up that you or I can't necessarily think of. The builders are going to build and do. And so I'm hopeful there are going to be more new ones created. We actually just in DC with one of our companies, Area 2 Farms, where they're franchising vertical farming. And when they talk about what is needed to manage a vertical farm, especially in a dense urban area where you don't have a lot of space, and because it's more vertical, you're going to have a whole new trades of people who are working on the robotics that help manage those farms and make sure the lettuce, grows on time and whatnot. And so again, we're already seeing AI, robotics, they're two sides of the same coin, creating new jobs, new opportunity, new innovation, better quality of life, right? Everyone deserves access to high quality, well-grown produce, right? Whether you live in a rural community, whether you live in a city. And so I feel like it'll be a net positive. That doesn't mean it won't be a bumpy road. And, how do I prepare my 8-year-old and a 2-year-old for this? I've already been paying attention. I've been tweeting about things like Alpha School, which I think are taking a really smart first principles approach to education. I do think the future of education for, let's say, K through 12 looks a lot more like having guides instead of teachers, and that's verbiage from folks like Alpha School and Prenda, where your personalized AI tutor is doing a lot of the instruction, right? I'm a big Duolingo user. You're familiar with that. That is probably the
great platform
expression of that, right? And there's no reason why a kid, regardless of their background, regardless of their home life, shouldn't be able to get personalized education. So if they need extra help with a certain part of math or a certain part of English, fill in the blank, you're going to have AI solve those problems for them, giving them that infinite access and infinite patience to support and customize learning. And then hopefully those kids get to spend the rest of their school day actually interacting and building up their emotional intelligence and solving problems. And I think the school of the future should really optimize the time with the AI to help learn, but also maximize the time off a screen so that kids are getting the things that are going to continue to be valuable when they grow up.
Alexa, let me channel the sports side of your brain. And earlier on today, I had a really good chat with Ted Leonsis, owns the Wizards, several other teams. His portfolio is valued at, I believe, close to $8 billion. We mentioned the Lakers, valued at close to $10 billion. You have been an early supporter, investor of women's sports. When in the world is this valuation gap closed between women's sports and some of these mind-blowing valuations on the med side of the equation?
Look, it's coming quick. My tweet about how undervalued women's professional sports was in March of 19 went viral for all the wrong reasons, right? Everyone, I said this is a massive opportunity. I said I was going to either start or buy. It was an NWSL team, a professional women's soccer team, and one day it was going to be worth billions. And most people said I was an idiot and no one watches women's sports and that'll never work. And I said, save those tweets. And he ultimately paid a little over $1 million for the expansion fee to start Angel City FC. And in the wake of that success, right now it's valued at the most for any American women's soccer team. Arthur Blank in Atlanta just paid, I think, $160 million for his expansion fee. So that's quite an appreciation over just 5 years. And so it has been really validating to see, to call the shot, to spark that and see the growth. But I think anyone will tell you it's just the start. There is so much more room to grow. And remember, most of these men's teams' value is based on media deals that have been baked over decades. And, whereas for women's sports, when we're building a team, I just bought the LA franchise of League One volleyball. And it was just like 2 weeks ago, so hot off the press.
Congrats. Wow.
We build out, thank you. When we build out the structure for how to build that team, most of our revenue is not going to come from a media deal. Most of our revenue is going to come from brand deals. And so we've been able to build, Angel City's doing tens of millions of dollars in revenue a year. You're seeing a precedent here for more and more women's pro teams to basically build the muscle of revenue generation in a way that's much more about, business, right? It's about how do you drive revenue through brand partnerships and all these things that it turns out lots of CMOs are excited by. And the media deal is still down the road. So you have to earn that media deal through the viewerships, but the brand dollars obviously help you build the brand and prove the value. And it's this virtuous cycle. And you've seen that in the rapid ascent of WNBA team valuations and revenues. And I think, it won't be for every sport, but you can see the places I've been investing, obviously also starting a Formula One for track and field like Athlos. That's an entire league where I've seen this same opportunity that I saw with women's soccer, where the World Cup showed up every 4 years and then everyone was watching and then they all disappeared. The thesis was simple, why not make sure they don't disappear and keep investing? Similarly, track and field is the #1 Olympic sport. These athletes are superstars and then they disappear. They shouldn't disappear. So we built Athlos and 4.5 million people tuned in for our New York meet just a month ago. And we're rolling out a multi-meet league next year with teams. So I'm excited about all this. I think at the end of the day, we're only 5 years away. I think 5-6 years from my tweet. And I think there is still so much more room to grow in women's sports. I think we will absolutely see billion-dollar women's sports teams as I had laid out, and I will be sure to rub that in the face of all those haters on Twitter 6 years ago.
Last one, and I wanted to save this one, Alexis, because I think this is also in your wheelhouse, and it's also in the wheelhouse of my dear friends at Yahoo Sports. Why are collectibles having a moment, and what is next in this industry?
It has been an amazing ride. We love our partnership with Mantle and Yahoo. We've got some hobby awards right now, actually. I think this industry is starting to professionalize, right? The hobby was always a very mom and pop type business. And during COVID, everyone was locked down. Everyone was feeling pretty anxious, and nostalgia became really, really desirable. And so that's when I got back into the hobby. I collected cards as a kid, like a lot of kids in the 90s. I thought that collection was going to help me retire one day. It did not.
Coming up, we're looking at some of today's trending tickers. Stay tuned. You're watching Market Catalysts. Now time for some of today's trending tickers. We are watching Constellation Energy, Williams-Sonoma, and Tesla. First up, Constellation Energy, the power company receiving a $1 billion loan from the U.S. to reopen 3 Mile Island, or at least one of the reactors there. The move comes as the Trump administration pushes to add more atomic power to the electric grid. Constellation has said it expects to reopen the reactor as early as mid-2027 at a cost of $1.6 billion. One of 3 Mile Island's 2 units is permanently closed following the worst nuclear accident in U.S. history. Constellation planning to reopen the other unit, which was shut in 2019 because it couldn't compete economically. Next up, Williams-Sonoma, the retailer which owns Pottery Barn and West Elm, reported revenue and earnings that beat estimates for the third quarter. Under the surface, its flagship Pottery Barn stores continued to underperform. Third quarter sales growth came in at about half of Wall Street's expectations, but overall same-store sales did rise 4%, driven by its West Elm and Williams-Sonoma brands. The share's down about 1%. And Tesla, we're watching that one today as the EV maker has been cleared to offer ride-hailing services in Arizona. It's one of the states where the car maker eventually aims to operate its robotaxi business. In Austin and San Francisco, Tesla's operating but has yet to offer rides in vehicles without human safety monitors present. The EV maker is looking to catch up with Alphabet's Waymo, which has been offering driverless rides for years now. As always, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Coming up, some of the top analyst calls on Wall Street, plus a look back at some of the biggest moments from Yahoo Finance Invest. We'll be right back.
Welcome back to Yahoo Finance. I'm Brooke Palmer. We're live at the NASDAQ here in Times Square. Let's turn now to some of today's top analyst calls on Wall Street. We're watching shares of DoorDash, Home Depot, and Molson Coors. First up, let's take a look at DoorDash because Jefferies upgraded the stock to buy and raised its price target on the stock to $260, up from $220. The analyst said the food delivery company reset expectations, providing flexibility for both long-term investments and upside estimates. The analyst said after the recent stock sell-off, its strong execution and growth algorithm are now underappreciated. Next up, let's take a look at Home Depot because Bank of America lowered its price target on the stock to $430, down from $450. The analyst there cited weak housing turnover and consumer uncertainty that tempered his expectations near term. Now, despite that, the analyst there reiterated a buy rating on the stock and expects Home Depot to gain share, especially within its pro business. And lastly, let's take a look at shares of Molson Coors because Wells Fargo moving to the sideline on the stock. The firm downgraded the stock to equal weight from overweight. The analyst Chris Carey said competitor Anheuser-Busch can deliver top and bottom line growth into 2026, whereas Molson Coors has tough visibility into volume trends with sustained category softness and share losses. Keep it right here on Yahoo Finance. We'll be tracking all the latest market moves and top calls throughout the trading session.
Yahoo Finance Invest highlighted some of the top leaders in AI and crypto last week. Here's a look at some of the biggest moments from the event.
All these things we've been saying for 20 years, and you know what? They pissed off a lot of people in the league. I run into people all over America and quite frankly all over the world. People who have like normal means who are now rich because of Palantir.
The math is pretty simple. We expect Bitcoin to appreciate about 30% a year for the next 20 years. There's no doubt in my mind Bitcoin will be a larger asset class than gold by the year 2035.
It shook us all to the core because fans need to trust that they are seeing real-time competition and that the outcomes are fair.
It was 9 p.m. in that AI party. It's now 10:30 p.m. But that party goes to 4 a.m.
There are elements of a bubble, which means that people will end up with losses. But the aggregate value of what's being created is significant. It makes sense to take a venture capital approach to AI. The payoff is so large that it is rational to have multiple investments and to overinvest.
The economy at the top level is strong, but again, it's being driven by this really important set of investments in AI. The rest of the economy under the hood is really stuck.
Government's going to change, tariffs going to change, leaders going to come in and out, and various other things are going to happen. You can never put all your eggs in one basket. That's always been the rule.
Vaccines have saved the world and will continue doing that. In the long term, it's the most cost-effective medical healthcare intervention.
We make an investment and the management team The day after we make that investment, I can promise you, they are getting together and they are going to do more than they would have done faster than they would have done.
Most companies, when they think about their business, dealing with retail investors is pretty secondary or ancillary. They're worried about, making sure that they're launching products. Our business is inherently different. Retail investors are at the core of not just our investor base, but also our customer base.
We're mining Bitcoin for roughly 50 cents on the dollar every single day, 24 hours a day. We're mining Bitcoin and we're adding it, and we believe this asset's going to be transformational.
Things were looking great. Then all of a sudden you have a shutdown that occurs, something that comes completely out of your control. We can't do business like that. We need more, from our government leaders.
Coming up, we're going to check the winners and losers among ETFs during the recent market sell-off. That's next. You're watching Market Catalysts. Well, stocks have been selling off in November, but investors have still been putting money to work into equity ETFs. Large cap equity ETFs attracted over $24 billion of flows last week, with international equity ETFs gaining about the same amount over the past 4 weeks. Joining us to check the pulse of the broader ETF picture during this period of instability is Noel Archer, AllianceBernstein Global Head of ETFs and Portfolio Solutions, for this week's ETF report, brought to you by Invesco QQQ. Noel, thanks for being here.
Thank you so much.
So there is this sort of mental disconnect, right? When you see stock prices going down, but you see money going into equity ETFs. So what gives?
Yeah, I would say it's not even just equity ETFs. We've seen flows into fixed income. A little bit of softness maybe in the alts and commodity space, but alts is a pretty broad definition. I think what we're seeing is a lot of questions. We're at a period, I don't know if we think about this as sort of slack tide or where we are, but you've got some big earnings coming out. You've got questions on where rates are going. You've got the normal year end, do you lock in profits or do you give into FOMO and keep riding with it? So, the ETF market's gotten so broad that you just have a lot of participants taking views on both sides of those multiple coins.
Yeah, gotcha. So that can drive some of it. International is quite interesting too, because we've had that move into international. We've had outperformance of international on a return basis this year. Has that been a pretty consistent trend also?
Absolutely. I mean, we've seen a tremendous amount of flows into international ETFs, both on developed and emerging market. And again, as far as really interesting things in the year, October was the first time you saw U.S. domestic flows, international developed and international emerging markets all sort of bringing money in. And that's, there's a few pieces driving that. As you said, performance for the first time in many, many years, you're seeing this sort of heavier performance in international and EM exposures than you did in the U.S. Again, the U.S. has not been bad by any shake, and it's still above historical averages. So folks have been definitely going into non-U.S. exposures, partly with the thought as different countries and economies maybe reset their spend onto a more domestic profile, that sort of means it's a bit of a more persistent investment trend as opposed to just, okay, this is something happening this year.
So we're getting close to the end of the year. And so when you look at sort of this year for ETFs, what are some of the big picture themes? What sort of will have defined the ETF landscape this year?
Yeah, I think a few topics. I mean, it's just the persistent use of the vehicle. People transitioning either from individual securities or maybe from mutual fund positions and using the ETF because of the flexibility the structure gives, some of the tax efficiency that it can lend itself to. We saw record-breaking flows into ETFs last year at $1 trillion by year end. We hit $1 trillion by October of new money into ETFs. So that trend is definitely there. I think this utilization of ETFs, beyond just the traditional, right? We've seen a lot of flows into large cap equities. Part of that is on the domestic side, again, the sense that, okay, this U.S. exceptionalism is continuing, but there's also, a heavy footprint there in some of the tech securities. And so the broadening out, the looking at different ways of investing sort of in the U.S. or abroad is there. A third of the flows in the U.S. have gone into active ETFs, which have really come onto the scene more in the last 4 or 5 years in a significant fashion. This year, again, heavily tilted towards new launches in the active space. About 85% of the new funds launched have been active ETFs. Wow. And so a lot more choice for investors as to whether they want to go into the beta side of the coin or more into something that might be a little more proactive around what's going on in the market conditions and how to dial up. And frankly, it's not an either-or situation. We're seeing many, many investors just pairing the two together to get some beta exposure within the asset class that they're interested in, and then pairing that with an active construct that might give a little bit of flexibility.
Yeah, that makes sense. The flows that are coming in, do we know if they are transferring from mutual funds, for example? Like, do we know how much of it is that versus new money coming into ETFs?
Yeah, it's always a little bit of both, and it's hard to say there's an exact one or the other. We have seen fairly consistent outflows in long-dated mutual funds over the last 8 years. That does not mean mutual funds are over. There are many strategies that don't fit in an ETF where the mutual fund works fine. The retirement space is very much geared that way. But when you think about the non-retirement space and a lot of the long-term funds, it's coming in some from mutual funds, some just from cash redeploying. We can't forget about the $5-6 trillion in money market funds that's still sort of parked there on the sideline. And so as there's a transfer of interest into where those investments are going to go, that's been a big infusion as well.
And then just really quickly, last month there was a record number of new ETFs launched, right? 137. Are there too many?
I don't think so, and that might be, I might have a bias on that one, but really when you think about breaking those numbers down, a lot of the new issuance is either in an outcome orientation, so you're just trying to increase income, or you're trying to control for risk, but there's also a whole lot of the funds that are variations, right? You have sort of the inverse, the levered, the single stock, you've got an equal weight of a major index, you've got alt weightings of an equal index, so it's really about flavors so much as, is there just too many? Because there's a lot of investors out there using ETFs now. They all have different views on what's going to work for their portfolios, and there is sort of a flavor for each one of them to access.
Makes sense. No, thank you so much for coming in. Appreciate it.
Thanks for having me.
Coming up, we've got full market coverage ahead in the second hour of Market Catalyst. Don't go anywhere. 90 minutes into the start of U.S. trading, I'm Julie Hyman. Let's get a check of the markets. Taking a look at the major averages here, we have this bounce back that's losing a little steam, particularly when it comes to the Dow, which is now off by nearly 1/5%. It's off right now by about 70 points or so. The S&P 500 still hanging on to a gain of about 0.5%, and the NASDAQ is higher by about 0.9% because we continue to see some strength here, some bouncing back in what's going on with large cap technology. Just looking inside the Dow, by the way, to look at the reasons behind the weakness there, I'm seeing stocks like Boeing, United Health, Salesforce, Chevron, and Amazon all trading lower, in addition to some of the retailers like Walmart and Home Depot under some pressure there. So that's why we're seeing the Dow underperform at the moment. And speaking of retailers, Target cutting its full-year profit guidance, warning of a weak holiday season after reporting a drop in third-quarter sales. Joining me now, John Sanmarco, Neuberger Berman, Senior Research Analyst. John, thanks for being here. And Target's really obviously been kind of struggling here for a while. What does this quarter tell you about its progress or lack thereof in turning things around?
Great. Thanks for having me on. Nice to see you, Julie. I think not much. We've had a CEO regime change, and so we will have to see the execution of the new plan and see how it evolves. And I think it would be a little premature to have expected a major step function. Target's quarter was weak, as we knew it would be, and clearly they're suffering from some own goals, and we'll see how the new team cleans some of that up. But they're also, to be fair, I think they're also a little bit in the wrong place at the wrong time, just in terms of where the consumer's strong and where the consumer's not strong, and some of that will work itself out. I don't think it's fair to penalize Target for having home exposure, for having middle income exposure, and those are some pockets that are, to be fair, are under quite a bit of pressure. So, just to sort of wrap the thought, I think Target's a reasonable proxy for the consumer. And, it seems like the consumer's ending 2025 with a little bit of a whimper, but 2026, we should see some comeback. And then I think Target's new plan and execution will really be put to the test.
I want to ask more about that new plan, but I'm curious about markdowns, because I saw some commentary that gross margins were hurt to some extent by markdowns. How is that going to look going into the holiday season and into this current quarter? Do you think they're still going to be under that sort of promotional pressure?
I think broadly, across retail, we'll see it in Target, relative to folks we think of as their peers like Walmart and Amazon, is highly sort of exposed to, we'll call it the degree of difficulty of managing inventory. For one, they just have inventory that has more volatility. They've got more, localized stores of that inventory that's kind of hard to put in the right place at the right time. So it's always an issue. I mean, really, I would venture to guess out of the last 10 years, half or more of the years, there's been something that, has kind of felt episodic around an inventory cost, either marking it down or storing it or some other kind of seemingly unusual event. But at some point, I guess you sort of have to think of some of these costs as fairly usual. I also think we'll see that across retail. And, you didn't ask about it, but TJX is a competitor, a peer that reported great numbers today. And, they're perfectly positioned to clean up when it's very difficult for retailers to know the right quantities of inventory to order into place.
So do you think, so let me ask you one more Target, then we'll talk about TJX also a little bit more. So if we're looking for that turnaround to maybe take hold next year for Target, what's like the lowest hanging fruit? Where can we expect maybe to see them first start to gain some traction?
Sure. First I should say, retail turnarounds are very rare. They're very hard, and I don't think it's hopeless, and I'll get to that. But the goalposts are moving, I think, is a really apt analogy. Like, just take this quarter as a case in point, and they're comping down 3%. Pick a high benchmark like TJX is comping up 5%. They both have reasonably similar cost structures and asset bases, and it just puts a winner like TJ in this great place to reinvest and flow something through for shareholders. And Target's really kind of pushing a boulder up a hill and racing a very fast runner while they're doing it. Now, that said, I don't think it's hopeless. What I've liked that I've heard most recently is incremental focus on newness and taking risk with assortment, and not being such a vanilla grocery store that happens to sell apparel or home, but rather sort of leading with what Target is known for, which is unique merchandise, great assortment you can't get elsewhere. So those are that's the fulcrum that I'm focused on. There was a data point today, it probably won't get any attention. I actually thought it was rather interesting, was the 20,000 new SKUs for holiday, up 100% year over year. That's really interesting to me, because that's the pathway, I think, toward Target getting back to winning, is separating themselves.
Sell more stuff that people want. It sounds simple, but that's kind of it. Speaking of which, let's talk a little bit more about TJX, which I guess is selling more stuff that people want. And the stock has really been an outlier to the upside this year in what has been a challenging retail landscape. But it's not just this year. TJX has been outperforming. So what's your view on what is the special thing there?
Oh gosh, what more can be said? Heads they win, tails they win. In seriousness, I think when you have a great environment for their unique off-price model, this is like a steady 5 to 6 comper, and I don't mean to make those numbers sound easy. Those are terrific achievements that drive a lot of value for shareholders. In a tougher environment, when things are in their face, you're talking about a 3 or a 4 comp story, which can create a lot of value for shareholders. And so they seem to, it's the flexibility, I think, that explains how is it that every type of environment we can draw up, they're able to succeed in. And what's really great about this environment, I think, I think this gets better prospectively, is just it's kind of where we started with my comments around the inventory management difficulty. The difficulty of managing inventory for their competitors is their opportunity. It creates closeouts. It weakens competitors, and in many cases, competitors get weak enough, they start to contract. So that's wallet share opportunity that I think has been a nice tailwind, is going to stay that way. And then just on the inventory piece, when there's I just do not envy the job of TJX's competitors who are trying to figure out how much spring apparel inventory to carry and, to put on shelves in February versus April, when the consumer is, just been very from 1 month to the next, it seems like we're in a completely different consumer environment. So those uncertainties are going to accrue to TJX, I think.
I was just looking at the numbers. 16 years in a row that the stock has shown positive returns, which I didn't quite realize. Ross is close, but with an exception. But I mean, the consistency of TJX performance is really unusual for a retailer.
It is very unique, and I think they rather than sort of flow it all to the bottom line and feel all the gain today, I think they just continue to reinvest and sort of lengthen the runway for themselves by retaining the very best talent in the industry that has kept this going and building out the supply chain capabilities that make what they do possible. So I think the future is as bright as as bright as the rearview mirror for TJX, fundamentally speaking.
All right, I got to ask you about one more, John, and that is Lowe's. Why is Lowe's seemingly doing, or why last quarter at least, did it do so much better than Home Depot?
They have narrowed a gap. A little bit of it is comparisons, but yeah, I think Lowe's has gone from a good company in a great industry to a great company in a great industry, and notwithstanding the cyclical pressures the home improvement industry is facing at the time, but they've just it seems like they've upped their game across the board. Out of the gates when they're no longer a new management team, but when the management team got there several years ago, one of the first places they invested was inventory and assortment that serves the pro, and that's been a gift that is kind of self-reinforcing. You drive more volume, you could carry more inventory and more of the right stuff for the pro, and some of those gains I think have had long-term implications. They're running better stores, and it's a good rational industry where some of the other sub-industries of retail we could talk about, when times get tough, you see knives like really come out competitively, and so to go back to the goalpost analogy of retail, turnarounds are hard because the goalposts move. I think in home improvement the goalpost moves a little bit more slowly because the industry just competes on factors other than price, but rather service, completing the project, having the right brands, dynamics that I think lead to a more rational industry. So they put together a great team and they've taken advantage. And to your point, they're now going toe to toe, or at least in the third quarter, outcomped a very high benchmark in Home Depot.
John, thanks so much for your perspective on all these names. Appreciate it.
Thank you.
Coming up, we got much more markets action. Stay tuned. You're watching Market Catalysts. Some of the biggest names in corporate America descended on the White House for the Saudi Crown Prince's visit. Notably, Elon Musk was in attendance for the state dinner last night with President Trump and Mohammed bin Salman. The appearance marked Musk's first time at the White House since their public feud earlier this year. But it wasn't just him. Everyone from Nvidia CEO Jensen Huang to Salesforce CEO Mark Benioff were in attendance. Even football star Cristiano Ronaldo was there. The Salesforce CEO acted as an unofficial photographer at the event. He posted a series of pictures that you're seeing here that he posted on social media from the White House. Let's get more on the takeaways from the Saudi Crown Prince's visit so far with Yahoo Finance's Jennifer Schomburger. And it's still going on, by the way. Many of these CEOs are still in D.C. There's a forum going on right now, and many of them are speaking, Jen.
Good morning, Julia. That's right. A lot of executives in attendance there at that black tie dinner last night at the White House for the Saudi Crown Prince Mohammed bin Salman, where President Trump revealed that the U.S. has inked deals on both defense and the economy with the Saudis, and also revealed that Saudi Arabia is now going to be designated as a major non-NATO ally.
That's why tonight I'm pleased to announce that we're taking our military cooperation to even greater heights by formally designating Saudi Arabia as a major non-NATO ally, which is something that is very important to them.
underscoring that Saudi Arabia is now going to be designated as a major non-NATO ally. The U.S. inked a defense deal with the kingdom with future sales of F-35 fighter jets. These are going to be top-of-the-line fighter jets, similar to what we give to Israel or sell to Israel. Also on tap as part of that deal, a sale of 300 American tanks to Saudi Arabia as well. Now, on the economic side, the U.S. and the Saudis also formalized that Saudi Arabia is going to increase their investment in the United States by up to $1 trillion. That's up from previously $600 billion. Both sides expected to talk in the coming weeks about trade and specifically reducing non-tariff barriers. Now, they also signed a multi-billion-dollar nuclear energy partnership, as well as a critical minerals framework to help diversify supply chains for critical minerals. As well, both sides signed what is being billed as an AI memorandum of understanding that will give the Saudi kingdom access to U.S. technology while still protecting against foreign influence. Now, the president expected to head shortly to the Kennedy Center for the U.S.-Saudi Business Forum, where we expect many executives there as well. Senior White House official telling me moments ago that the president is going to speak about how America is the best place on earth to do business. He's going to tout how he's been trying to work to rebuild our economy, securing investments to create jobs and help bring down inflation. Julie?
We shall see. Jennifer Schonberger, thank you. Appreciate it. Well, the crypto markets had a very volatile few weeks, hitting a peak of $126,000 per Bitcoin in October, and then briefly falling below $90,000. The CEO of crypto exchange Kraken joined me at Yahoo Finance Invest to discuss how the market's changes have affected his business.
The more it goes up, there's speculation around it, so people get interested in it, and then they try to buy the asset. When it goes down, you tend to get a little bit more negative news, but that's across every asset class, crypto, ETFs, stocks, shares, et cetera.
So are you concerned at all that with that volatility that, that there is this drop in traffic, and how long do you think that this drop in crypto could last?
Yeah, so for our platform, we have over 400 plus crypto-related assets. We have all of the stocks and ETFs in the United States, as well as some international stocks that are going to be on the platform soon. So for us, it's across the board. One thing I think that's important is if you just look at the general slope of crypto, Bitcoin from 6,000 to 15,000 to 25, back to 8 to 50, back to 16, then 80, et cetera. You always have these curves that have continued to change for all asset classes. And I think what's much more important is what is the thesis behind why you'd want to buy Bitcoin or Ethereum or any of these assets versus hold a dollar or any other shares.
And do you think that sort of philosophy or reason for buying it, that is going to expand regardless of what happens to the price?
Yeah, there's going to be micro and macro cyclicalities across all jurisdictions. So the U.S. perspective is that we'll take a look at traditional markets, but we're in Australia, Canada, United States, UK, Greater Europe, et cetera, and then the rest of the world. All of these markets, in some cases, they don't have access to their own equities markets. So they're looking to buy assets that they consider safe. Most of the time, those assets are US assets. And crypto is one of those as well. So Bitcoin, Ethereum, the alts, Solana, et cetera, become sort of more synonymous with safety over time. And then the next phase of safety has been US Treasuries, which are stable coins, and then tokenized equities have been like a huge boon for us and other platforms as well, which is essentially similar to US Treasury as an asset that's safe. People want access to McDonald's, S&P 500, Nvidia, et cetera. And I think that's great because you're leveraging the global liquidity, global access, global distribution through any global platform out there to be able to get access to these assets no matter where you are in the world, no matter what platform you use.
I do want to get more into tokenization, but first to kind of take a step back here for people who aren't as familiar perhaps with Kraken. You guys have a lot of traffic internationally as well. There are a lot of crypto platforms now. As I mentioned, you guys have been around for a long time, but there are a lot of crypto platforms that are accessible here in the US, and we're seeing an increasing number because existing platforms like a Robinhood, for example, has gotten more and more into crypto. So how should people think about Kraken? What is the identity of Kraken versus some of those other platforms?
Yeah, so I'd take a step back in that the TAM is large, right? The total addressable market around how to get people access to these financial products in the first place. So over time, you've seen a lot of these fintech companies just give broader access, underbanked. You have neobank services, et cetera, sort of converging on giving people access to any type of yield or savings. So the way to sort of think about it is you have all this open access. We talk about open internet, open banking, et cetera. Well, worldwide, that hasn't really happened that much. And so the first new movement worldwide in terms of distribution is mobile phone, access to internet, and now global internet capital markets, which is essentially crypto. And then you're moving assets into that. And so we've been worldwide since day one. We've been fully remote since day one. So it just gives us access to a larger pool of customers. I think what has always made us different, frankly, is outside of core features is our culture. So what do we stand for? We stand for your property and your money is yours. It's your sovereign property, similar to how we think about our own freedoms and assets here in the United States. We want to be able to bring your assets, similar to how we think about crypto, is like it's interoperable. You can move it the way you want to. If you want to opt into a program that gives you a certain amount of yield, and you go to who you trust. And so we're vertically integrated in that way, which is we're an exchange like NASDAQ, and then we have an interactive broker-style platform for you to be able to use our products to be able to buy any of these assets that you want. And so crypto is where we started. Crypto native is how we were born. But those principles are what carries us for all the other products that we give access to. So, a lot of people talk about financial inclusion. I think of it more as how do we get more and more participants to get into the ecosystem. Crypto is the rails in the back end for us, and in some cases it's freedom to do whatever you want with your money. But the ability to have freedom to do what you want with your money is to be able to have forward mobility in the first place. So at a time where we're talking about, how do I participate in the capital markets, we're talking about socialism in some cases, what do I actually get for my money and who are the services that I use? I think the traditional institutions are capped to high net worth individuals and larger folks that have pooled capital for better products. We want to bring all of those products to everyone worldwide.
You guys also have expanded more into the retail side. You bought a company called NinjaTrader earlier this year. Historically, you had been more a home for maybe professional traders. And again, this is an area that some of your competitors are getting into more. Coinbase, for example, is leaning more institutional now. So is that a threat for you guys? How do you think about that competition?
Yeah, I generally don't like the terms when people say retail or institutional. It's as if you're pitting people against each other. And so, what does the average consumer do when they're starting off, like as an entry point? What does someone do when they're, in their midlife of their career? And then what does a high net worth individual do? Like that's the aspiration for everyone, right? Like whatever your asset might be from your job where you get paid a salary plus a bonus and maybe equity depending on how you work. And so worldwide, these things are changing. And so the way in which we categorize our customers is that we started off with an exchange for active traders and professional traders worldwide. They eat the same, they think the same, they read the same, they were educated the same. Purchasing power parity is very similar worldwide. They're the basis and the strength of our liquidity, our global platform, our rails, and they just give us the ability to create all these products for consumers. And so, traditionally people will say retail, but I think of retail as like this transactional model of an individual. It's like, what do you care about? What do I care about? What will my kids care about? And so it's consumers on their journey, and then we build a separate set of products for them that are powered by our liquidity engine or Kraken exchange. And so the interface is different. So we have a app called Kraken, which is for sending, receiving, and getting yield, similar to how someone who is a high net worth individual would get. So if you want a 5% yield, hopefully in the future 8 to 15% yield, instead of having millions of dollars to get access to that product, you can have $5,000 or even $1,000. And then for our institutions, what they really care about is custody, safety, security. So we offer a lot of these yield products. So the DATs that we all hear about in the public markets, we support them.
Digital asset treasuries.
That's right. The companies that want to buy and hold on their balance sheet Bitcoin or Ethereum or any alts, we support that too. And then there's these protocol companies that are listing their tokens, we support them as well. So this is not any different than banking and financial services and the institutions that we're used to. We are building institutional products, but they are supported by our customers in the first place. And we consider as a part of our ethos, free and fair and level playing field. So a professional trader, a consumer, or an institution, when they come onto our platform, they're able to trade, store, save, get products all at equal access.
Coming up, we'll look at some of today's trending tickers. Stay tuned. You're watching Market Catalysts. Now time for some of today's trending tickers. We're going all in on retail stocks. First up is Lowe's, the retailer bucking the slowdown that Home Depot saw amid strength in its online business and sales to contractors. Joining us for more Yahoo Finance's Brooke DePalma. So Brooke, we've been trying to sort of get at why and how Lowe's did better this quarter than Home Depot. I talked to an analyst earlier who said part of it is the comps for, year over year. What are some of the other reasons that you're looking at?
Julie, well, this is actually a question that I posed to Lowe's CEO Marvin Ellison, and he said that while he can't talk about the competition, he said that the company has really invested in recent years in technology as well as AI, and also their small to medium pros business, something that they've been ramping up over the past few years. And what we saw in this quarter was that they had positive same-store sales growth in 10 out of 14 categories, despite what he said was a 100 basis point hit from storms last year. They also saw double-digit sales growth when it came to Lowe's.com, their home installation business, as well as major appliances. And they did see strength in that small to medium pros business as well. Now, Julie, you're probably wondering as well about this effect of these higher mortgage rates. And as you can see on your screen, I did ask him about that as well. He said candidly, going into the year, they thought, hey, maybe we would see lower mortgage rates. But now he's switching to this idea of the lock-in effect. He said that home improvement, these customers with a 3%, a 2.5% mortgage rate who are currently living in homes that have those lower mortgage rates, well, instead of moving out of those homes, they're likely going to take out larger home equity lines of credit, and they're really going to reinvest into their homes that they're currently at that have those sub-6 mortgage rates that are quite literally non-existent right now.
Wow. All right. Let's also talk about TJX, the parent of TJ Maxx and Marshalls, seeing strong demand amid the rise of an increasingly frugal consumer. It's interesting, Brooke, because the numbers look good. They raised their forecast. The stock is down a little bit right now.
Yeah, the stock is under pressure after we did see a bit of a pop at the open. Keep in mind that heading into this report, the stock is up more than 20% year to date. And so there's been lots of momentum, lots of discussion about off-price retailers doing well in this environment as consumers are choiceful. Especially this has been a discussion that we've been talking about even since tariffs back in April, as consumers sort of sought out lower prices in this, tariff environment. Also keep in mind the call is currently underway, and so we're waiting to hear about what they say about the state of the consumer, about the outlook for holiday. They're pointing to a strong holiday outlook right now. Some key points that they are making on the call is they said they feel great about the strength of our business. They're confident about the flexibility, wide customer demographics, something that's really important in this K-shaped economy, and also their focus on value. Also keep in mind other companies as well. They also have Ross stores that they need to size up against. So definitely TJ Maxx isn't alone in this environment of winning where off-price retailers are doing well.
Yeah, definitely. All right, thanks so much, Brooke. Appreciate it. We got much more markets action coming up. Stay tuned. You're watching Market Catalysts. It's been a huge year for AI stocks, reshaping global markets despite concerns about valuations. Josh Lipton sat down with Palantir CEO Alex Karp to talk about it at Yahoo Finance Invest. Here's a look at part of that interview.
Where I do have a bone to pick with traditional financial people, including their minions, the analysts, some of them, not all, is, do you know how much money you've robbed of people with your views on Palantir? It's like they have all these views. There's no downside risk for their view. At what point, it really should be next to every statement. I said don't buy Palantir at 6. I said don't buy Palantir at 12. And the welder, plumber, technician who didn't buy it or sold too soon, I owe them money. And by the way, let me tell you something about Palantir that is very positive. By my reckoning, Palantir is one of the very few, if not the only, where the average American bought and the average sophisticated American sat on the sidelines or sold.
What do you think explains that?
Yeah, because the average American was a lot smarter than they were and listened and was not bigoted, was not held down by a whole set of training beliefs that we're wrong. Like, what does it mean to build enterprise? What does it mean to have FTEs? What does it mean to go to market? What does it mean to get paid? Does your enterprise have to be parasitic? Should it be a parasitic? Should the host essentially be paying for the privilege of making your company larger and getting no value except for a weird feeling that you get from the parasite that you're better than you are? It's like essentially replicating the whole woke mind virus in the enterprise. You know, they were open. By the way, they were also not only, they were not bigoted against some obvious truths that we've been saying for 20 years. With, by the way, these views when they were not popular.
Like what, Alex?
Like America is a better way to organize and live than any other place in the world. That even though it's better, we shouldn't be exporting, or especially it's better, we shouldn't export. We don't need to export our values abroad. We need to be strong enough in America so that nobody screws with us. Including my views on the border, like we should have an actual border, we should have an actual culture, we should have meritocracy, we should not tolerate discrimination, and discrimination means against white males or whatever that is. We should build the best products. The products are going to have to be much better than any other products in the world, or they're not going to get implemented. I mean, all these things we've been saying for 20 years, and you know what? They pissed off a lot of people in the elite. You know who they didn't piss off? The same people we're also making AI work for. The truck drivers, the plumbers. I run into people all over America, and quite frankly, all over the world. People who have like normal means who are now rich because of Palantir. You know who's not rich because of Palantir? The people who read the analyst notes and the people who wrote them. And you know what? They're also still kind of angry because while they're cruising along in their broken down car, the person cruising next to them in their beautiful Tesla is an actual worker in this providing actual value who may have gotten rich on Palantir. By the way, I love that. Nothing makes me happier than looking in my mind's eye at the bank executive who's hanging out with their thing, who's living on the drip of some high interest loan, watching some person who's free, American, riding their car, who did not go to an elite school, but knew enough, because they didn't probably go to elite school, to buy Palantir shares. And now are going to make even more money using our platform.
Let me ask you this. I want to end here. There is a book coming. I want your view on this. It's a biography of you, The Philosopher in the Valley. When I read this book, is it going to be a fair, balanced portrait of Dr. Alex Karp?
Well, I mean, it'd only be fair and balanced if everything was good. Look, it's 70% accurate. It's very.
What's the 30 that's not?
He's got Trump derangement syndrome, obviously.
How does that come out?
Like anything that Palantir's done, it's basically two books. It's one book about my childhood, which is a complex background, and came from nothing, and highly dyslexic, and amorphous. It's like the whole thing: amorphous background. A little bit too amorphous racially, a little too Jewish, a little too very dyslexic, political. That part's fascinating. It's a little hyperbolic, but it's like 85, 90% true. Mm-hmm. Then, of course, the Trump derangement syndrome, the fact that, President Trump did these courageous things in Iran, and closed the border, and Palantir's played a role in these things. Obviously, not the role that the people did the work or the president, but that just sets off this mind virus. So Karp has to be evil. It's, that part of the book obviously is, but it's so obvious that you can kind of read through it. And yeah, there's some things, but I guess it's a good read. I think people read it will say, oh, wow, that's really interesting. There's some things about Alex I didn't know. And, you can assume all the things you don't like about me are on the inaccurate side, and all the things you do are accurate. But I think a lot of people are going to read it. I think people will enjoy reading it.
Since we're talking politics there, final question. And we've been talking for a long time, the two of us, years. How have politics changed in Silicon Valley as you've watched it? What's the arc been like, and how has that, if at all, impacted the defense tech sector?
Well, I mean, I'll tell you, the thing I get in most trouble for in my intellectual circles is the following statement. Silicon Valley, like the rest of the world, will listen to you if those ideas make you money. Now, of course, you still have to have convincing ideas that are true, but if those ideas are not tailored to real world things that work, in the Valley, quite frankly, is dollars, they will not listen. The fact is, and again, whenever I tell this to my intellectual friends, they stop talking to me because they want to believe that pure ideas change the world. Pure ideas don't change the world. I'll tell you what changes the world. Pure ideas backed by the military, in this case, hopefully the US. Doesn't mean you have to use the military. If you're strong enough, Like, this is where I'm like, Palantir is not a neocon project. Our project is to make America so strong we never fight. That's different than so almost strong enough so we always fight, right? So your ideas get listened to if you are dominant on the battlefield, and hopefully so dominant you don't have to use it, but if you do use it, people are like, yeah, I'm not screwing with those. Or if those ideas make someone a lot of money. You still have to have the ideas. In part, the intellectuals get so angry, my intellectual friends, it's like because they just think they write a book, someone reads it, and it changes the world. Nuh-uh. And like, that's not the way intellectual projects have ever worked. The ideas have to have a real world input. And so the fact that Palantir is at whatever we're at, this changes the Valley, because not only was the patriotism right, but the patriotism will make you rich. And that's what that impact on the Valley is going to be very long lasting. And I'm very proud of that. But again, you can't just be proud of the idea. That was right from the beginning. It was been right since the history of our country, that our way of organizing, especially our Constitution, is superior. It's certainly superior for Americans. Again, superior for us doesn't mean we export it to everyone in the world, but superior for us since conception. But to make people listen up in their seats, you need to be dominant on the military and dominant on the economy. And Palantir plays a really but-for role in both of those areas. And that's something that I'm proud of, because not just because of the impact, but because the way in which it reverberates both in Silicon Valley and outside. And by the way, it also stands for, anyone can make it. One of the things that's in the biography is, read where I came from. Read that. Like, there's no reason you can't advance in this society. And that's an important lesson for everybody, especially outside the Valley.
Nvidia earnings are dominating the headlines, and on today's Stocks in Translation, we're taking a look at how you can play Nvidia stock based on historical probabilities. So first up, I've shown this chart many times before, but basically, if you were to buy Nvidia stock right before earnings and you held it for 1 day, 1 week, 1 month, 1 quarter, 1 year, this is the return that you might have expected over the last 10 years. So we're looking at the median returns over the last 40 reports, 10 years. You can see not much going on. 1 day later, 2%, 1 week later, 4%, 1 month later, 2%, but the odds start going up when you hold for longer periods of time. At 1 quarter, you're looking at a 14% median return. And then this is really the focus here. After 1 year, you basically saw a doubling of the stock price. Now I want to show you, these were the median returns. I want to show you the win rate, or the percent positive for the same time period, 10 years. So 1 day holdings, that was positive 60% of the time. 1 week, 65%. 1 month, 58%. Anything under 70%, by the way, I consider to be subpar, because stocks tend to go up. When you get to 1 quarter, and remember, that's when we were getting that 14% return, then we see the odds shoot up to 77%. And 1 year later, you are up 83% of the time. So it just kind of shows you that you want to be in that buy and hold mode, unless you are a very, very nimble trader, because some of these shorter time periods are barely better than a coin toss. Now I want to show you what the experts are doing. So this chart goes back a few years. In white, we have Nvidia stock price, and in green, we have the median Wall Street price target. And as you can see, it's usually above. That is, the price target is usually above the price. And sometimes Wall Street is playing a game of catch up. So you'll see, like right in here, a few times that the stock price actually exceeded that Wall Street target here too. And the last time we caught up to it was probably a couple quarters ago, and you can see there is a rather big disparity between the target and the price. Over the last 90 days, since that last earnings report, Nvidia stock has basically done nothing. It's just about flat. Meanwhile, the average price target, or median price target, is up to 237. That is a gain of 19% over that time. So the big question is price going to once again catch up to those price targets, or is there going to be a big disappointment? And is that price target eventually going to catch down to the stock price? We'll have to see about that one, but history says, at least over the last 10 years, and especially the last few years, that Nvidia stock probably catches up to that target. Now we're going to take a look at post-earnings moves. Now these are just moves, and we're talking about range of trading. We're not talking about up or down. So the average daily move in Nvidia stock any given day since its last earnings report is 3.4%. Now what the options market is implying, that is expecting over the next day after the earnings are announced, Tomorrow, on Thursday, what is the return or what is the range going to be? 7%. So basically more than double that. And then I took a look at the last 10 quarters, so that's 2.5 years. What was that post-earnings day move? Well, that was actually 10.7%. So we have seen a reduction in volatility over the last few quarters here with respect to Nvidia stock. So that's something to keep in mind. We'll probably see above average volatility in the earnings reaction, but that's also going to be probably maybe double what we've seen over the last 90 days on those non-earnings days. Now I want to get into the return. So this is how much money you would actually make. Post-earnings average return over the last 10 quarters, 3.6%. Now, 6 of those were wins, 4 of those were losses. So of those 6 wins, it was a positive a return of 9%. And of those 4 negative losses, those were 4.5% on average. So you put it all together, Nvidia stock is kind of a tricky one to play sometimes, especially in the short term. No doubt it has been a long-term winner for a lot of investors here. And make sure you check out the earnings later today on stocks on Yahoo Finance Network, and tune into the Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcast. Stay tuned for more market catalysts up next.
The median age of homebuyers in the U.S. has risen to 59, and the number for first-time homebuyers has risen to 40. That leaves a large swath of Gen Z and millennials on the sidelines of the housing market. So my next guest is CEO of a company that developed a blockchain-powered tool that could give those folks an investment track to the real estate market. It's Mogul CEO Alex Blackwood, and he's joining me now in studio. Thanks for being here.
Thanks so much for having me.
So I guess, first of all, let's take a step back, because you're part of this cohort that we're talking about, millennial, I'm guessing.
Yep. Yeah, exactly.
And so, we've been talking a lot, both here in the show and the bigger media and cultural landscape about the affordability crisis when it comes to real estate. So, how do you think about that, and then how to approach it from an investing perspective?
Yeah, I mean, the way that I think about this platform is it always needed to exist in some form or fashion. I mean, if you see home prices are running away, and real estate is the largest wealth generator for generational wealth within the US. So this needed to happen sooner rather than later to give everyone access to real estate by clicking online. And so that's exactly what we built, as a way for people to invest in real estate as easy as investing in a stock.
And do you find that your users who are investing on the platform, do they own their own homes, or is this a way, are they seeing this as a vehicle to eventually build up enough assets to then buy a home? Are they renters who are investing in real estate?
So when we first started out, we thought we'd be the Robin Hood for real estate, with the idea being that anyone can access high quality single family rental homes. But then our returns started to speak for themselves, and our average return right now is about 18%, and that just goes back to our backgrounds. We were both at Goldman Sachs, myself and co-founder, where we were investing billions on behalf of the institution. And so today, the way that it works is a large majority of our investors are actually people that own their own homes or own multiple homes, and are coming to us because they see an easier, more headache-free way to invest. Now, the average allocation to a per property basis is around anywhere from 15 to 25K per property.
Okay, so let's talk a little bit more about how it works, right? So we were talking during the break, you guys own around 40 properties. I think you said 42 properties.
Yeah.
And as you mentioned, they're single family homes, and you're owning them and managing them and renting them out. Is that how it works?
Yeah, so the way I describe Mogul, it is the greatest way to invest in real estate. And so the idea being that Mogul came about because myself and co-founder, when we were both at Goldman Sachs, we were looking at ways to invest in that high quality asset outside of our day jobs. We didn't really see any platforms that allowed for it, and so we decided to build our own. And the idea being that you go on to mogul.club and you pick and choose from highly vetted assets that are the highest quality of assets, and then as you invest in that asset, you get monthly rental income, appreciation, and tax benefits in real time. For instance, we pay out monthly rental income for October tomorrow. And so you can start investing and start earning right away.
You make it sound very easy. It's not easy to find a house to buy, the right market rate at which to set it, to collect the rent on time. What surprised you through this process? Have you found those points of friction maybe that you didn't expect?
I think there are always going to be points of friction, especially within the traditional brick and mortar real asset class. However, that's where we come in. We bring our expertise to make it easy for anyone to invest while we take care of the headache. So there aren't going to be the 3 a.m., 10 a.m. calls. There aren't going to be the dealing with the leaky faucet at 1 in the morning. And so we actually deal with the property managers, and anything that's below $1,000 in spend, we take care of. Anything that's above $1,000 in spend, the individual gets to actually vote in a simplistic manner, governance rights on the individual asset.
Oh, interesting. Okay, and if somebody comes to your platform, they're not just investing in a big fund that buys these houses. They actually choose the specific home that they're investing in?
Yep, yeah. I mean, we built it so that you would have the autonomy to choose the assets, but we like to say it's kind of like shooting fish in a barrel, because we've already pre-vetted the assets, and hell, I even invest in each individual asset that comes to the platform. So people can pick and choose. They can do weighted dollar cost averaging, or they can just pick one specific asset type.
We have seen an increase in the types of platforms like this, not necessarily this specific one, but sort of more accessibility to investing in real estate, whether it's commercial or residential. Is that the way that you think things are going in sort of bigger picture?
So bigger picture, I do think there are going to be a greater proliferation of these types of platforms. However, I liken it to the early days of social media. If you look at MySpace, it was quickly usurped by Facebook, which is a more quality platform. Now, the initial cohort of platforms that came to business, I mean, the returns on there, I don't want to speak ill will, but it's ones that we initially looked at and said we need to create our own platform to build out. And so I do think that eventually there will become more and more quality players in the space, and we aim to be the first quality and transparent platform for real estate investors.
Alex, thanks for coming in.
Thank you so much for having me.
That's it for Market Catalyst. I'm Julie Hyman. Thanks for watching. We've got more Yahoo Finance coming up.